I take it everyone can hear me. Assalamu alaikum. My name is Talal Tabba', and I'm going to be talking to you today about, is crypto secure? So there's actually no definitive answer for this question. No one in this world will be able to tell you yes or no. And if anyone does, quite honestly, they're not being honest. So I guess before we start, a little bit background about myself. I've been working in crypto for about 5 years full-time. I've co-founded 2 companies, CoinMENA, which is a regulated exchange based in the Kingdom of Bahrain, which accepts customers from across the GCC. And then Jibril is a blockchain development company in Switzerland. On the more traditional side, I sit on the board of Middle East Payment Services, which is a traditional payments company. And I previously worked at PwC. Studied engineering, which has nothing to do with what I do today. So crypto is an exciting new industry with so much potential, but a lot of unknowns. So I guess to start, for today, we'll talk about 3 main risks. Because when we talk about is crypto secure or the security of crypto, that isn't only how you custody crypto. There's actually multiple types of risk. And today we'll talk about security risks, regulatory risks, and then finally volatility risks, because those are all related to whether crypto is secure. So, but before that, I want to do a bit of basics, right? When sometimes people confuse how does a transaction get actually recorded on the blockchain? So let's go with a traditional transaction first, and then I'll try to compare that to a blockchain-based transaction. If I'm sending money from Talal to Bradley via a traditional bank, the bank has multiple functions as part of this transfer. They need to verify that I'm actually Talal, that Bradley is actually Bradley, and I have enough money to send to Bradley. And once that transfer is done, there is a settlement and reconciliation process that ensures that I can no longer spend that money again. If I had 10 dirhams in my account and I sent 10 dirhams to Bradley, the bank is responsible to make sure that I can't spend that 10 dirhams again. And that's something that's extremely important. And throughout history, we have used centralized entities in order to do this functionality, right? We've used escrow. If you think of the function of escrow, right? I want to give something and get something back. I need to trust an intermediary to facilitate this transaction. And that's why blockchains are called trustless systems, because you don't need to trust an intermediary in order to transmit value from one person to the other. So this diagram probably describes it in a better way than I would. So how does a transaction get into the blockchain? So first, a transaction is requested and authenticated. That means Talal wants to send 10 units to Bradley. After that, a block representing this transaction is created. So we create like a container and we put the transaction into that container. And then this block is sent to every participant in the network. In the previous example, we used to tell Emirates NBD, please debit Talal and credit Bradley. What we're doing here is we're informing everyone that is on the blockchain. So when I say on the blockchain, there's the Bitcoin blockchain, that's one. There's the Ethereum blockchain, that's another. And there's multiple types. For now, let's just stick to the Bitcoin blockchain. So what actually happens is this block is transferred to absolutely everyone. So we broadcast it to the network. And then once it's validated, the miner or the entity that verified this transaction gets rewarded with a fee. So traditionally, we would have paid the bank a processing fee. In this case, we pay the processing fee to the miner that actually broadcasted this transaction to all of the network. Once that is done, once that transaction is confirmed, it is then added to the blockchain. So actually the name blockchain is actually quite descriptive. It is a chain of blocks, and each block contains 1 megabyte worth of transactions. Once that block is full, literally full from a storage perspective, we move on to the next block. And that's why blockchains are considered to be secure. And again, I'll give a caveat on secure, because there are instances where blockchain-based systems have been manipulated. And I'll walk you through an example just a bit. So this is called proof of work. Proof of work means there is a miner that has actually done work. They spent electricity in order to verify that transaction. And that's why sometimes people criticize Bitcoin for being not very energy efficient, because the miners actually have to spend a lot of electricity in order to verify these transactions. Because again, we said that the miner that verifies the transaction gets the commission. And what that means is the faster you verify, the more likely you are to get compensated. And that's why you have to spend a lot of electricity. So I should have probably started with this diagram, but okay, this explains the difference between a centralized system and a decentralized system. We used to use an intermediary to make sure that value moves between Talal and Bradley. Now we're using a decentralized system where I don't have one single point of failure. If a specific bank is not online or it's the weekend, I'm unable to send money from party A to party B. With blockchains, I don't need everyone to be online. I just need at least 50% of the network to agree that this transaction took place for it to be recorded on the blockchain. So we use the blockchain as a solution to remove intermediaries. And that's why sometimes crypto that's why crypto is often described as a way to disintermediate financial services. Cool. So how do we disintermediate financial services? What does that actually mean? So if we take a step back and think of the internet, this is a picture that describes a central server. So let's say I want to interact with Facebook, right? Facebook have their own servers, and I interact with them as a user, which means the internet acts as a way to connect our devices with this computer with a tower. So the connection is made in the middle. However, the data sits on the edges, right? A great example to explain this is accounts payable and accounts receivable. Let's say I'm company X, and again, we'll use Bradley as company Y. I need to pay Bradley $10. In my books, I record that I need to pay Bradley $10, but maybe Bradley recorded $11 on his books, which is why we need to do reconciliation, right? At the end of each month, my accountant and Bradley accountant sits and say, hey, I owe you 10. He says, no, I invoiced you for 11. We find the settlement, and we reconcile at the end of every month. This is a process that's very common in traditional finance. And the reason for that is because there's a way where we're connected. However, data sits on the edges. With blockchains, this structure is completely reinvented where the data sits in the middle. So this is what this diagram shows here. Company A and company B agree on every transaction at any point in time. So that's why in blockchains, we say that there is no need for reconciliation or settlement, because it actually happens after every single transaction. So at any point in time, I'm able to know how much I owe Bradley, and Bradley knows how much I owe him with absolutely no disputes. So if we think of financial innovations, think over 1,000 years ago, or just less than 1,000 years ago, the Medici family in Venice created the debit and credit accounting system, which is today the backbone of pretty much everything in finance. And we owe a lot to this debit and credit system. However, it had its shortcomings in terms of reconciliation. Today with blockchain, it's called triple accounting or triple ledger accounting, where reconciliation literally happens after every transaction. And if this does sound a bit abstract, we'll make sure that we leave room for Q&A. So, data integrity and 51% attacks. This is something where is very blockchain specific. And if we work with Emirates NBD, we know, or if we work with any bank, we know that this bank maintains a ledger of all of its users' balances. Talal has 0, Bradley has 5, X has 1, and we trust this bank to maintain this ledger in a centralized server. When it comes to blockchains, we actually depend on the majority of the miners. So if 51% of the miners say Talal has 10, that's what's recorded on the blockchain. Correct? So that's why we depend on the majority of. So today when people say Bitcoin is unhackable, technically, if someone spends an insane amount of electricity to be able to control more than 50% of the miners, they are able to change the data that's there in the blockchain. So people sometimes say blockchains are immutable. The reality is blockchains are immutable unless there is a 51% attack. So when there's a 51% attack, that means a malicious party took control of over 50% of the validators and are thus able to change the data that sits in the blockchain. And that has happened in smaller coins. This obviously didn't happen in Bitcoin, because if it was to happen in Bitcoin, it would be very cost prohibitive. So there's kind of a game theory check and balance there. Okay, so we talked a little bit about I guess the risks of data integrity. I'll then talk a little bit about, is crypto storage secure? Over history, we've seen many instances of exchanges, wallets, and other types of storage mechanisms be hacked. So let's say if I'm storing my coins on there was an example of a Turkish exchange that wasn't regulated, and therefore some malicious actors were able to siphon the funds away and pretty much take the money and leave. So we'll talk about the different types of crypto storage and the advantages and disadvantages of each. So the first is a paper wallet. The paper wallet is basically an offline key. It's literally a key that allows you to extract. It's like a username and password that's never been connected to the internet. So it's not very user-friendly, but it's considered to be one of the secure options. The web wallet is probably one of the easiest to use, because you can just use your internet browser like Google Chrome or Mozilla to access your crypto, yet it's not very secure because it's directly connected to the internet. Hardware wallet is actually one of the most secure options, because at least if you're using the top types, which is Ledger and Trezor, these types of hardware wallets come with what's known as HSM encryption, and they're considered to be pretty safe methods of storing your crypto. And then you have your mobile wallet and desktop wallets. Those are, I think, self-explanatory. One of the important things in crypto storage is that regulated exchanges actually need to custody their crypto at a regulated custodian. So for example, us at CoinMENA, we work with a company called BitGo, who actually custody the crypto on our behalf, because quite honestly, I don't think there's any company in the Middle East that is currently capable of custodying crypto, because it's something that's very technologically advanced. And even if you solve the tech part, it's virtually impossible to convince an insurance company based in the Middle East to insure an offering like this, right? Because at the end of the day, this is a new industry, which means it comes with unknowns, and you need to, security is like an onion. There is no thing as this is fully secure. You have to keep on putting layers and layers to make sure that your users are safe. And what we've done at CoinMENA is we've worked with probably one of the more expensive custodians, but that's because the deposits are insured up to $100 million. They are insured by Lloyd's London, and one of the few custodians that actually have an insurance wrapper around crypto. And one of the very critical parts is that in the SWIFT system of sending money around the world through banking, transfers aren't actually final, which means if I send money from one bank account to the other, and there's some sort of fraud case or some sort of issue, there is a recourse mechanism where you are able to retrieve the funds that have been sent. Obviously, it's not as easy as clicking a button, but there is a process to facilitate that. Whereas in crypto, transactions are final. If I send you my Bitcoin, I can never receive it back unless you send it back to me, or if your wallet gets compromised. So that's a little bit on crypto storage. Honestly, if you have crypto, and actually, can I see a show of hands? Who here has ever bought or owned crypto? Hello, great, 2021, amazing. This number used to be significantly lower, and I'm very happy to see that slowly but surely it's improving. 2% of the world, less than 2% of the world own crypto. And I'll end with that slide because I use it way too often, but it's a very powerful one and shows you kind of where we are in this cycle. So yeah, in terms of storing your crypto, I would suggest using either an offline wallet, like a hardware wallet, or using a regulated exchange that has a custodian that is insured. And another very important piece is never depend on your username and password. Every crypto service provider, or almost every, at least every legitimate crypto service provider, has what's known as two-factor authentication. two-factor authentication is basically an additional security layer that ensures that you can't log in with just your username and password. Because guess what? Username and passwords can get leaked, they can get compromised. So you need to include another layer, which comes in the form of two-factor authentication. And Google have a very good product called Google Authenticator that is quite easy to use. Cool. Let's look at the overview of global cryptocurrencies. I took this from The Block, which is one of the more popular news outlets for crypto. They obviously aren't completely accurate, but this gives you an idea of where we are. This is supposed to be in 2021. UAE, very favorable. Bahrain, very favorable. In my humble opinion, the Central Bank of Bahrain has released one of the most comprehensive and logical crypto regulations out there in the world, which is why me and my partners have decided to set up shop there. It's actually a very interesting concept. Throughout history, people would move closer to water or closer to energy. If you think of how Saudi has progressed over the past 50 years, oil has been a primary driver of that. If we want to go back in history to the United States, you had people stay in New York, close to the water. People migrate Midwest, and they stayed next to Chicago because there's a lake. And then people made it out west. Today, we're seeing people flock towards, maybe I'm overly optimistic, but that is actually, there's people that have moved countries in order to make sure they comply with crypto. I left Saudi to move to Zug, Switzerland, a small city in 2017 because of their crypto regulations and setting up my first startup. And then now in Bahrain, and inshallah DIFC being the leading financial center in the Middle East, it makes sense for them to regulate crypto, and that's why we're very pleased to be taking part in this DIFC blockchain week. But yeah, basically it's still up in limbo, right? There will I don't think we'll ever have a situation where you have global acceptance or global rejection of crypto. Because even the internet, which now is probably as important as anything else in this world, was actually fought by many countries. Like I remember in the 90s, internet was actually banned in Syria. Like you couldn't use the internet. You had to go through like this dodgy alley to access MSN. It's, governments sometimes take actions that don't make sense. We have to remember that at some point women weren't allowed to study. Like you couldn't go to school, you couldn't vote. So just because a country bans crypto doesn't mean it's the right decision. It's just the natural reaction of human beings to reject anything they don't properly understand, which is why it's amazing when you see regulators take progressive moves, because it's not their comfort zone. And there's no shame in admitting that. One of the things that I think the Central Bank of Bahrain does very well is they say, you know what, we've licensed you, but there's elements that we need subject matter expertise. Like we have a quarterly security audit that's done by a complete third party, similarly to how you would audit the financial statements of a bank on a quarterly basis. So there's intricacies related to the regulations and implementation of crypto that will continue progressing over time. So in my first one, I was quite optimistic. Now I need to show the other side of the equation. In 1933, it was illegal for any private person to own gold in the United States. This was basically an order by the Federal Reserve Bank issued by the President of the United States saying that you need to give anything you own in gold to the US government, and then we give you dollars back. This sounds insane, but it actually happened in 1933, and we never know what can happen, right? I personally am very bullish on crypto, but as we've seen in China, people had businesses worth hundreds of millions of dollars. Even Bitmain was worth billions. Yet, without prior notice, the Chinese government decided to ban mining across China. Again, we live in a world where borders don't mean as much as they used to. So if you get banned in China, guess what? You'll go to another country that's open and favorable for business. And I think Dubai is an excellent example of that. I don't know any other country in the world where over 85 or 90% of the people come from other countries seeking opportunities. It's our day's age is American dream, I guess. Especially being from Jordan, going to work in Dubai is something that a lot of people aspire to, because honestly, the economic opportunities are significantly more appealing. Anyway, back to this. the US government had historically banned owning gold by private persons, whether individuals or corporations, which basically means that anything could happen. If crypto was 100% legal, Bitcoin wouldn't be trading at $50,000. It would be trading at a significant. So that's part of the risk that you are taking by coming in, I guess, early. Yeah. So I previously showed gold and banning gold, and now I'll try to explain why I believe Bitcoin is the digital replacement or a digital competitor or complement to gold. And we look at 5 different, that's 7. Okay, that's 7 different metrics on comparing gold and Bitcoin. This is from the Winklevoss brothers, you know, the Winklevoss twins that basically had the issue with Zuckerberg. They then took their money and bought Bitcoin with it and went to set up an exchange called Gemini. They released some of the best content in crypto, and this credit goes to them. Let's look at Bitcoin and gold. So in terms of scarcity, Bitcoin's supply is fixed. And what does fixed mean? Is I can tell you the supply of Bitcoin today, I can tell you the supply of Bitcoin on 1st of January 2012, and I can tell you the supply of Bitcoin in 2050 by the minute. This is something that we had never been able to do in any type of financial asset. So that's why I say the supply of Bitcoin is fixed. The supply of gold is scarce. Why do we say the supply of gold is scarce? Is because there's about 200,000 tons of gold above the Earth's surface. And throughout history, there has never been an increase of over 2% in the gold supply. That's why gold is considered a very good store of value. Because if you want to store your value with something, you want to make sure that no one can print or issue additional supply, because that will affect the price. We have to remember that price is always a function of supply and demand. So let's assume that demand is fixed, right? Let's forget demand and only think of supply. If the price of hazelnuts expands by 10x, guess what? I'm going to go find hazelnuts so that I can sell them to the market, capitalize on the profits, and then the price of hazelnuts will go down. This applies for lumber. This applies for pretty much any commodity in the world except for Bitcoin, as gold, and now Bitcoin. So that's the discussion on scarcity. In terms of durability, one is hardware, one is software. In terms of portability, Bitcoin can be sent anywhere in the world, just like an email. With gold, it's a lot harder to transport. In terms of divisibility, you have up to 8 decimal places with Bitcoin, whereas gold, you have a troy ounce. In terms of storage, anyone with a phone can own and hold Bitcoin. But for you to custody gold, you either need to put it under your mattress, which is traditionally something that was popular, I guess, but I don't know how many people will be doing that in 2050. But a lot of people will be holding Bitcoin in their digital devices, whether it's a phone or I don't know what we'll have by then, but yeah, I don't think it'll be a shiny rock. In terms of storage, we said digital wallet or safe. In terms of counterfeiting difficulties, gold is difficult to counterfeit, but it's possible. And we've seen many instances of gold bars that are actually silver from inside, or other types of other methods of counterfeit. With Bitcoin, you can tell with absolute certainty if this is a real Bitcoin or not. And it's become much easier to make that verification. And today there's, again, regulated exchanges and regulated offerings that ensure that you only receive an original Bitcoin. But yeah, it's very easy to verify. When I took this screenshot on where this diagram was made, Bitcoin's market capitalization was 200 billion. We're sitting at above $1 trillion, I believe. So that, sorry, 1.4? No, 2.4 is all of the crypto industry. And I'm talking about Bitcoin specifically. Bitcoin is about above 1 trillion. It was 200 billion at the time. Gold is 9 trillion. So again, nothing I say today is investment advice. So just needed to make sure that disclaimer is there. But if Bitcoin was to reach gold's market capitalization, it would have to almost do a 9x increase for it to match gold in terms of market cap. But if history over the past 20 years taught us anything, is that Amazon is going to beat the retailers, Netflix is going to beat Blockbusters, Uber is going to beat the taxis, Airbnb is going to beat the hotels, and guess what? Bitcoin will eventually become the could become the self-sovereign store of value that is resistant to inflation. And for that to happen, we'd see seismic shift in market dynamics. So again, I was talking about is crypto secure, but sorry, what's the eighth one? Understanding. Okay, sure. That part I agree with you. Gold is. I personally don't understand gold as Talal. And humans give value to, like, if I tell you this is worth X and everyone in this room agrees that this is worth X, it'll become worth X. That's just how the world works. Gold is worth $9 trillion. The industrial use of gold is less than like 10% of that. Fine, we make some necklaces, but is it actually worth $9 trillion? 100%. What you're talking about, sir, is called the Lindy effect. And the Lindy effect basically says the longer money stays valuable, the more likely it will be valuable down the line. Which is why with every passing day that Bitcoin doesn't get shut down or gets hacked, it becomes stronger and stronger. And that was one of the main statements of Satoshi, the founder of Bitcoin, the pseudo-anonymous founder of Bitcoin, saying that with every passing day that Bitcoin is alive, it becomes stronger, similarly to gold. But yeah, I do agree with you that education is not there, which is exactly why we're having this session. Okay, so price discovery and volatility go hand in hand. This is not Bitcoin's price. This is Amazon's stock price. And throughout its history, it's had multiple double-digit drawdowns. People always say, oh, Amazon's a blue chip. It can never go down. Well, in reality, between October 2011 and December 2011, it went down 30%. So people always think, with stocks or with equities or with commodities, prices are stable. But the reality is, when you're going through a price discovery phase, you will have volatility. And what do I mean by price discovery anyway? What is the fair value of a specific asset? No one knows what's the fair value of crypto, which is why we see a lot of volatility on the way. If I show you the financial statements of a company, you will be able to tell me, yeah, this is how much they have assets on their books. If we discount their cash flows, this is a fair valuation. These types of metrics aren't quite there yet for crypto. So this was the Amazon chart. And then Bitcoin's chart is a little bit more dramatic, where we've had multiple. So this was round about the time between 2016 to 2019, where Bitcoin literally exploded in price. We had multiple drawdowns of 38, 35, 36%. So what I'm trying to say is that if you think that volatility is a deterrent, then you're probably not ready to own Bitcoin. If you have a long-term view, then volatility is your friend. It's not your enemy. Because if it's volatile, but the overall direction is up, I don't care. I'm not putting all of my money in Bitcoin where I need to draw down to pay my rent, for example. Right? If I have a long-term view that's 5, 10 years down the line, I don't care if Bitcoin drops 40%. Because in my mind, it's something that's a lot more ambitious, where over a long time period, it should be able to appreciate for multiple reasons that I'm happy to discuss afterwards. So why is crypto so volatile? One of the things that's very important is there's no central control over price. If you remember last year, I'm sure you all remember COVID. Yani, what am I asking? But if you remember what happened in the US stock market when COVID was rampant, the Nasdaq dropped 10% in a day, and the US government was like, you know what? Free markets, we don't want that anymore. 10% drop, khalas, circuit breaker. Stop, we're not going to trade anymore. That's actually what happens in countries like Jordan. In Jordan, if a stock goes up or down 5%, they stop trading. Khalas, we don't want it anymore. So it's quite interesting to see how countries that always promote free markets stand against it when it's not in their best interest. Right? The Nasdaq, which is supposed to be the free market of the world, they stopped trading more than, I think, 3 times during COVID, because people were selling and the government was trying to tell them, wait, we need to get our stuff together. and then they ended up printing additional dollars to support the market. Basically, what I'm trying to say, there is a centralized control over price, which means the central actor can manipulate and control the price. And that's something that we see today across pretty much any government offering, whether it's bonds, whether it's equities. So there's no central control over price. In Bitcoin, you have the price of Bitcoin trading on Binance and FTX and Coinbase and pretty much every Bitcoin market in the world. And then when I say today Bitcoin's price is 50,000, what does that actually mean? It means that it's trading on Binance at $50,002 and at Coinbase at $49,950, and the average is the Bitcoin price that we quote. So that's why the price is collected from multiple sources. The perfectly inelastic supply for Bitcoin is something that I briefly touched upon earlier, but it's something that is insanely important, which is no matter what happens in this world, there will be 90 Bitcoins produced every day. That's just how the code works. And what that means is that even if price goes up significantly, no one can create additional Bitcoins to dump on the market. And that's why having a perfectly inelastic supply means prices will be volatile. Because if there is a change in demand, you can't change supply, which is why price is the other factor that will be affected. And then final one is something related to regulations, is loose control over leverage. Basically, Binance, FTX, multiple exchanges around the world allow you to trade with significantly more money than you own. If you have $10, you can trade with $100, or some exchanges even give you 100x, which in my opinion is irresponsible and crazy, first of all, because crypto markets are already volatile. So when you're adding leverage to that, you're literally you're better off just going to the casino and having a good time. So final one is loose control over leverage. And that's why we've seen the UK government, Canada, etc., issue many warnings to exchanges saying you need to remove your leveraged products. But why does that equal volatility? Because if I'm investing with money that's borrowed, okay, I'll give you an example. Let's say I invested $10, but with 10x leverage. That means with every $10 I have, I'm actually investing 100. So let's assume the price of Bitcoin is 100, which means with $10, I had bought one full Bitcoin, even though I technically bought it with 10% equity and 90% debt. Let's say Bitcoin's price goes down from 100 to 90, I will lose everything that I have because I only have $10 in equity. Anyway, the issue of leverage leads to volatility, and that's something that we'll see reduced over time because these exchanges don't have as much flexibility as they used to, because regulators never move at the same pace as technology, and they're often reactive. Company X did this mess up, we're going to penalize them, and then they launch regulations. Until today, data regulations haven't kept up with what Facebook and Google are doing. So I don't know how long it'll be until we have crypto regulations globally. And then I'll end with this slide because I think it's very important to give a frame of reference. This is, I think I took it from Raoul Pal, who's one of my favorite thought leaders in the world of crypto. He used to be a macro guy, and then now is in crypto knees deep. Basically, what does this chart show you? It shows you the total number of crypto users and the total number of internet users across 2 time frames. The number of people using crypto today is similar to the number of people that was using the internet in 1998. So if you think you're late, you're not late. We're also not early. But yeah, I hope you found this session helpful, and thank you for your time. Yes, of course. Sure.
My question is related to regulations and technology, especially decentralized finance. So, if you think, can you advise us your view? Can you advise us your view on what's happening, for example, in the US? Coinbase is struggling on their lending platform.
it's centralized, it's not decentralized. But when it comes to decentralized platforms and regulations, that's a tough cookie for everybody. What is the stablecoins role there when it comes to regulations, and overall, what is decentralized finance regulation opportunity?
It's a very good question, and one that doesn't have an exact answer. What Coinbase were doing, in my opinion, has nothing to do with decentralized finance. They are literally launching a product that promises you fixed returns. And if there's any lawyers in this room, you'll be able to easily confirm that that falls under security guidelines. If I'm promising you X for every dollar you invest, then that by definition is a security because there's a promise of returns. There's in the US something called the Howey test, which basically allows you to figure out if an offering or an asset is a security. And basically what Coinbase did is definitely a security. And the SEC in the United States basically told Coinbase that if you launch this product, we're going to fine you and they're basically going to make their life hell. But to be completely honest, Coinbase is like the creme de la creme of exchanges when it comes to compliance. Like you have the wild, wild west happening in jurisdictions that are Seychelles and other jurisdictions that aren't as rigid as Uncle Sam. But basically, when it comes to decentralized finance, I actually think that another route will be taken. So I don't know who here remembers Napster or LimeWire and the different methods where you could download information from the internet. I used to download movies, but then I realized, okay, shit, this is pirating, and you're not allowed to do that. But anyway, the point that I'm trying to make is with Napster, there was one guy, Sean Parker, that was responsible for hosting the servers, and every time someone would download, he would, or his servers would actually send the data. So it was very, very easy for Uncle Sam to go and say, hey, you're breaking every type of privacy law out there, you're going to jail or you're going to get fined. There was one, in Arabic we call ras al-af'a, like the head of the snake that you can just cut off, right? There was one head of a snake that you can cut off. With decentralized finance, what's going to happen is the same thing that happened to Torrent. I don't know if you're familiar with Torrent, but with Torrent, essentially, instead of downloading from Sean Parker's database, you're downloading from absolutely everyone. So there is no snake's head that you can cut off. So with decentralized finance, projects that are decentralized will survive. Projects that have a central entity will get dinged. Uniswap is a great example. So Uniswap is the world's largest decentralized exchange. It is a smart contract. It is an immutable smart contract that lives on the Ethereum blockchain. And the function of this exchange is that it allows to connect buyer and seller in a very novel way. So Uniswap, even though it's on the Ethereum blockchain, there's a company that creates a website that allows you to interact with it. So what I think will happen is the government will be able to shut down this website because there is a centralized party that's holding it, yet the contract that's on Ethereum is completely decentralized. So there's absolutely no way of bringing it down. I hope that answers your question. But Uniswap. Many things. Today, there is over 60 different interfaces that allow you to connect with Uniswap. So Uniswap, why did I mention Uniswap and not Aave or Compound or the others? This is maybe something very specific to Ethereum, but whenever you deploy a contract, there's something called the admin keys. The admin keys essentially allow you to go in and change stuff. That's not available in Bitcoin. It's available on smart contracts on Ethereum. With Uniswap, the way that they've done it is there's no admin keys. There's absolutely no one in this world that is able to change the Uniswap contract. They might shut down Uniswap, the company, but guess what? Actually, there's a very interesting example that happened. There were some tokens on Uniswap that were securities. So the Uniswap guys live in the US and they're backed by VCs and whatnot, so they need to comply. So what they did is they created a front end that doesn't include these security tokens. But guess what? If you go to the contract directly, you can interact with them. So front end is something that in the world of Ethereum, you can create as many front end as you want. And the contract is open for everyone to interact with. But regulating decentralized finance will be a very big challenge. And I don't think that it will happen anytime soon. Governments are barely getting their footing when it comes to dollar to Bitcoin and back. So decentralized finance will remain the wild, wild west. People will make and will lose a lot of money, but that's the only way we'll progress. Please.
That's stablecoins.
Oh, yeah.
And then definitely the regulators, they have such an important role in decentralized finance. That will be the angle for regulators to jump in.
Of course. So what are stablecoins for anyone that didn't get this is stablecoins are basically coins that live on the blockchain, just like Ethereum, Bitcoin, and other types of coins, yet they are pegged to an underlying currency. So the most popular one is called USDT or USDC. These are tokens that can be sent, received, programmed, everything like crypto, yet they're backed by a dollar or backed by some sort of stable asset, which is why you have the advantages of transacting in crypto, yet you maintain your, or you don't take the volatility risks associated with it. So, sorry? Tether is $1, USDC is $1. Not always. There's been instances where it has fluctuated. Yeah. So in decentralized finance, if the US government issues a cease and desist to USDC, which is owned by Circle, which is a company owned by Coinbase and Goldman, everything's going to turn to, it's going to be a bloodbath. But that's why the DeFi industry is considered the high-risk one, right? If you want to get a loan for, I don't know, your house mortgage, unless you're into crypto full-time, like I personally use MakerDAO for my debt. But then again, I'm not a standard user of change to Aave. Yeah, I mean, I do use Aave for other things. Yeah, you should be very proud. You should be very, the work Aave have done is absolutely insane. So cheers to you and everyone from Finland. Great. Okay. But that covers the DeFi question.
SEC conflict with Coinbase. So if you're putting your money on staking it, so will your coin be affected, or how is it going to happen?
Okay, so you mentioned on Coinbase, right? Yeah. Coinbase is a publicly listed company in the United States of America, which means that they will not screw over their users. And even though I don't speak on behalf of Coinbase, this is my own personal opinion. But basically, throughout history, we've seen the US government penalize companies, but the user is rarely penalized. Because anyway, staking is different from lending. People always confuse these two, but they're actually not the same. Lending falls under the same regulations that were there in the past, which is under the SEC, whereas staking is something that's novel and something that's quite different. You're actually collateralizing, or you're sending your tokens for them to perform a security-related function. So when you stake on Ethereum 2.0, for example, you're actually helping verify transactions and you are paid for your staking efforts. If you fail to verify, you will get slashed. So it's not like interest. You can make money or you can lose money. But what you're actually doing with Coinbase is you are asking Coinbase to say, hey, I want to stake, yet I don't have the technical infrastructure to do it on my behalf, and then they take a fee. But if Coinbase mess it up, your stake tokens will actually get decreased. But since Coinbase have a pretty robust infrastructure, that doesn't happen. But yeah, I mean, staking is one of the, Albert Einstein was saying that the eighth wonder of the world is compound interest. I wish he was alive to see what's happening in compounding today in the world of crypto. Some of it is over the top, but then again, that's how technology works with the Gartner hype cycle. When initially there's a lot of hype, it dies down, and then we see slow and steady growth. Cool. Any other questions? Please.
Yeah, how do algorithmic stablecoins work, and what will be the effect on them with when the regulations come?
Oh man, algorithmic stablecoins is really the wild, wild west. I've lost and made very good money on stablecoins that's supposed to be stable. Okay, before we get into algorithmic stablecoins, I'll just give a quick example of the other types stablecoins. There's fiat collateralized stablecoins, and that's like USDC. There is a deposit in a regulated bank that is represented by a token that is like a claim to the underlying money. That's fiat.
Dollars on the blockchain, basically.
Dollars on the blockchain, exactly. And then you have something like DAI, DAI, which is a crypto collateralized stablecoin. You can lock up your Ethereum. So you can lock up $150 worth of Ethereum and get $100 credit in this form of synthetic or new stablecoin that is basically collateralized by your crypto. If your crypto value goes down over time, you either pay back your loan or you have to increase your collateral. If you don't do that, your collateral is sold off to pay off your debt. That's the second one, which is crypto collateralized. Algorithmic stablecoins basically try to mimic the functions of a central bank using smart contracts. So basically, if the idea is you balance supply and demand to ensure that the purchasing power remains neutral. So my favorite algorithmics or my favorite stablecoin is one actually called RAI, R-A-I. And RAI doesn't isn't stable in dollar terms. It's stable in crypto purchasing power terms, which is something that's novel and exciting. But there was a project called Basis, which started algorithmic stablecoins, I believe, or they raised insane amounts of money to do it. Then their lawyers basically said, pay back all the investors because algorithmic stablecoins are a direct competition with central banks. So I think they'll be regulated pretty heavily in the coming years.
Has RAI been launched now then?
Yeah, of course, RAI is launched. It's their founder is one of the smartest people in crypto. Very eccentric guy, but yeah, I personally like RAI. And the reason for RAI was actually DAI used to be only backed up with Ether. Now most of DAI's backing is USDC. So if Circle in the US goes down, DAI will also get screwed over. So that's why RAI only accepts collateral that's decentralized. Because if I'm issuing a crypto that's backed up by centralized assets, if someone takes these assets away, it ruins the credibility or the creditworthiness of the coin that was issued. So that's why I think RAI are doing quite an interesting job.
How would they be able to regulate algorithmic stablecoins though if it's all decentralized and will the algorithm be like an open source software? Like there's not going to be a company behind there, is there?
So okay, if they do it the same way Uniswap did, where they don't have admin keys, then it is possible. And basically lawyers are very creative. So what lawyers do is they find ways for your project to be decentralized enough for you not to be, like, for example, if Satoshi was a known entity, many governments around the world would want to get him or her and throw them in jail and figure out. So basically, anonymity or pseudo-anonymity is probably the easiest or most effective way of dodging regulations. I'm not saying you should do that, but if you were to, that would be the way to do it.
Can I give a little piece of education? Because we're talking about staking first, and maybe if you don't know what staking is, it's just you deposit the money inside on the platform and you get yield on that. But you were asking about Coinbase staking. It's not possible yet, and maybe never. We don't know about the SEC and US. But in Europe, there are regulated platforms. There, for example, one is called Nexo. It's regulated, and they've just been licensed also in New York, by the way. And the other one is Yield.app, and both are regulated. Yield.app, both are regulated in Europe, but they are not decentralized. They are dealing with their central entity, and you need to understand the risks also there. But they are regulated.
Yeah, 100%. I mean, today's presentation was, is crypto secure? Again, we go back to the same initial topic, is no one really knows. Like, no one can tell you in their right mind that it's 100% secure. But what companies do, like my Finnish friend said over there, is you work with regulated entities that have the checks and balances to protect basically investors and users' rights. Yeah. Any other questions?
How did you get started in crypto?
Well, a long story. Actually, my Chinese neighbor in university once asked me to use my debit card, and then a day later, I got a call from the bank saying, "What's this suspicious transaction?" And I went to this guy and was like, "Hey, what did you do?" He's like, "Come, I need to show you." I'm like, "No, you could have told me yesterday." Anyway, that's how I got my first Bitcoin, and then I forgot about it completely for good 3-4 years until my brother. Then in university, one of his professors actually distributed Bitcoin to everyone sitting in class. That guy is called Bruce Fenton. He's one of the OGs in the crypto space and used to be a visiting lecturer. And he gave all the students a bit of Bitcoin. That was like 2014. And then my brother was like, "Hey, man, I got the same thing you got a couple of years back." And that's when I'm like, okay, wait. I used to work at PwC and moved to Saudi. And if anyone's been to Saudi in pre-change, you'd know that it's not the most fun place to live. I used to spend a lot of time reading white papers, taught myself a bit of Solidity coding. That's when I used to have a lot of time on my hands and was spending it basically going through rabbit hole after the other. But again, I'd say that like many people say, "No, you've been in crypto for long." The reality is, it doesn't matter when you started in crypto. Like Michael Saylor, right, the CEO and founder of MicroStrategy, owns 105,000 Bitcoin. He only started last year. So Michael Saylor in 12 months did more to Bitcoin than many other people that have been around.
So today, Michael Saylor owns, I think, 140,000.
Oh yeah, he made another
more
purchase.
today.
Yeah.
Every day he announces.
Man, does it even matter after 100K? Like, yeah.
My question to Lal is,
yeah, I mean, the Elon Musk thing is. Sorry, please ask a question.
from a technical perspective, what are you most excited to see happening in crypto? So not mass adoption, not price discovery, like layer 2s, sharding, roll-ups. What are you excited to see technical?
Cross-chain interactions. That's one of the things that we've, like, I don't know if you've played around with Solana or other types of blockchains. There's something called Wormhole that allows you to take your tokens from Ethereum to Solana and back. And it feels like sci-fi because throughout the past 6 years, we've only been able to work with ERC20 or ERC271 or basically stuff that's based on Ethereum. And I do think that a cross-chain world that is not only... So when people say cross-chain, I would be very hesitant to compare. Like moving from Ethereum to Polygon or Binance Chain is very easy because everything is based on what's known as the EVM, the Ethereum Virtual Machine, and you use the language of Solidity to code across all of these. But in Solana, you use something called Rust. So your ability to move between one blockchain to the other, I think, will have huge implications. But I'm a boring guy, and I think Bitcoin is basically solidified itself as a digital alternative to gold. And we live in a day and age where if I'm going to bet on anything, I'm going to bet on volatility, right? If we've seen anything in the past 10 years is that I'm long volatility. And by being long volatility, I think Bitcoin is one of the best risk-adjusted returns. Plus, our friends or our neighbors in Lebanon saw how difficult it is to lose all of your life savings because some government wasn't able to do its job transparently. So I actually think that Bitcoin is a way to liberate people from a financial perspective. But from a technical standpoint, I would say one of my fears is basically what will happen when Ethereum moves from 1.0 to 2.0. So I've been an Ethereum user for a very long time. I also stake at home my Ether, and I'm a little bit worried to see, because at the end of the day, it's software upgrade, right?
Are you on Lido?
Sorry?
Are you staking on Lido?
No, I do it myself. Yeah. So I don't know if you know DApp Node. Yeah, so basically they provide
your own validator ultimately.
Yes, I run my own validator across. I also have, I don't know if you know Get Umbrel. It allows you to run your own Bitcoin node. So these are like side projects that my wife's upset that we have a room at home that only serves this purpose. But yeah, it's worth it, or at least in my opinion, it is. I'm sure if you ask her, she'll tell you otherwise.
I have two questions for you. One is, do you have a AED on-ramp, off-ramp for your exchange?
Sorry?
Do you have an AED off-ramp for your exchange?
On-ramp and off-ramp? That is our core business. Our core business is allowing you to deposit in dirhams, riyals, Omani through wire transfer, card, or crypto, and then also withdraw back to your bank account. So that's our core business offering.
Okay, and other question, what's your view on rebasing coins?
Sorry?
What's your view on rebasing coins like Ampleforth?
On what? Debasing coins?
Debasing.
Sorry, I'm having a hard...
Ampleforth? Have you heard of that?
Ampleforth.
Yes.
Rebasing. So algorithmic stablecoins. I do think they have a lot of potential, but I think any stablecoin that tries to work and be based on the US dollar isn't going to be what we use in the future. There will be a stablecoin, an algorithmic stablecoin that adjusts to the purchasing power of crypto. There's, again, I don't know if, sorry if I used this before, but it's something that I think is valuable, and it's something called technology infrastructure inversion. So today, people are building stablecoins that are focused on US dollars because that's what people know. Once crypto becomes big enough and we start measuring our purchasing power in crypto, we will see a technology infrastructure inversion where people stop using the US dollar-based stablecoin and move to one that's geared to crypto. Just to give an example on what technology infrastructure inversion is, when cars first came out, the roads were built for horses. They weren't built for cars. And people would say, yeah, cars aren't good, right? Because they can't really operate on these gravel roads. And then once people realized, okay, crap, cars are important, they started doing asphalt roads, and now cars are an important part of our lives. Even if we take the example of the internet, I'm sure all of you remember when you used to transmit internet using their telephone lines. Why? Because everyone had telephone lines in their house, and the easiest way to give people internet was through ADSL. I just plug into the telephone lines. It was not ideal, but it was the easiest way to go to market. Now, when internet is as important as maybe not water, but just below water, you have your cable connection, you have internet isn't coming through your landline, because guess what? We don't have landline anymore. So what we'll see in crypto is today people are doing it based off US dollar stablecoins. In the future, we'll start seeing it adjusted to purchasing power in the crypto world.
So do you think this will be what the metaverse will be?
Sorry?
I think this will be what the metaverse will be.
This will be what, sorry?
The metaverse?
Yeah, the metaverse? Yeah, possibly. I mean, I don't like to make predictions on that because no one has any clue. But if I was to make a bet, then yeah, that would be the case. I have quite a controversial view on this, so I speak on behalf of myself. But I do believe that in the coming 20 years, individuals and companies will have the choice of using publicly issued money, which is fiat currency, or private money, similar to how we have the choice of going to a private or a public hospital. Over the past 100 years, we've been kind of forced by having to pay taxes through the fiat currency issued by governments. With Bitcoin, we've started having a choice on whether we want to use private or public money. And I think if you look at history, it's very easy to tell that private corporations usually do a better job than the public sector. At least that's my opinion. There's exceptions, obviously. Dubai Airport is a great example of how public work can be absolutely not only great, but the best in the world. So again, I don't say this with full certainty, but yeah, I think we'll have private and public money in the coming 10 years.
Thank you.
Please.
There's a lot of information asymmetry right now, right? A few people know how crypto works. Do you think CBDCs are going to be a big challenge? Can they sort of tilt the market, or what effect would they have?
Okay, again, at the risk of sounding a little bit too philosophical, but I'll do it. You mentioned CBDCs, right? CBDCs are a form of money. Let's go back to the definition of money. What is money? In my opinion, money is a way to move economic value through time and space, right? I move economic value through time by saving or by holding, and then through space by paying. CBDCs will be an excellent way of making payments because I'm basically moving from an analog option to a digital option. When I have a digital dollar that I can send as easy as sending an email, I don't need to depend on the outdated plumbing of SWIFT, a correspondent bank, IBAN, all this outdated stuff. That's for moving economic value over space. In terms of moving economic value over time, nothing's going to change, because the US dollar and its ability to move value over time is dictated by the monetary policy of the US States government and other countries. So if you had $1 in 1971, when President Nixon broke the peg to gold, it has lost over 78% of its purchasing power. So even though Bitcoin is volatile in the short term, US dollars depreciate over the long term. And that's something that anyone can verify, because guess what? If you had $10 in your pocket in the year of 2000, it's not the same as having $10 today. So to answer your question directly, CBDCs will fix our ability to move economic value over time, but it won't fix our ability to move value over space. And that's why in money, there's never a winner takes all. I said this in the panel the other day, but until today, my grandmother gives me the idea, which is what you give on Eid break, in gold, because in her mind, gold is money, right? My dad maybe writes me a check, because for him, checks are money. For me, I'd pay it in Bitcoin, because so if you think of payments as a 100% pie chart, there will no be winner takes all. You won't have everyone move to one thing or the other. So again, and I went on a tangent, but CBDCs will have two forms. They will have basically retail focus that me and you can use. And then you have the other type of CBDCs that are designed to improve reconciliation processes on the banking level. And that's what we're seeing between UAE and Saudi, with the project Aber that aims to have instant reconciliation between the banks and the central banks.
At some point of time, some companies say that they can take Bitcoin as when you purchase something from them, and then sometimes they say, no, we have stopped this. So my question here is, how would you say in the future the Bitcoin would be a mode of payment, like currencies or maybe like a gold or whatever? So where you can think that it will reach? Right
Okay,
now,
so
you must have also heard this in news. Some companies, they accept and they have stopped it.
yeah, but the reality is, in my opinion, Bitcoin is more important than Tesla, Elon, or any type of company or entity. So Tesla saying we accept Bitcoin as payment doesn't have a very big impact on the fundamentals. It has an impact on the sentiment, which obviously changes price in the short term. Will Bitcoin be the internet, the money of the internet? That's something that remains to be seen. It is a non-zero possibility, but you can't say with absolute certainty that that will be the case. I do think that stable coins are actually one of the best ways of moving money around the world. Like we started to pay some of our vendors with stable coins instead of card, because guess what? On card, they charge us 2.5%. With stable coins, I'm paying 20, 30 cents.
My point here is, as you say now before in one slide, that at one point of time, the internet, the usage of internet and the usage of Bitcoin now, they are going same, right? So at some point of time, this will be increasing more in terms of institutional value, any other sources. So that could change the mode of payment. That I want to know.
Of course. Look, with
What specific company
yeah.
in the news, they accept it and they don't.
Clear.
When the interest of people will be increasing in percentage in say 20x.
Look,
With interest.
it's a possibility, but again, anything that is technology based, there is like the tech has to be right, the human acceptance has to be right, and the regulations also have to be supportive. So the internet made it, right? When in the 80s, the internet was a novel idea that was developed, and it started off as an intranet, a closed system. Now the internet made it, because there's internet infrastructure absolutely everywhere in the world. If Bitcoin continues to go on the same trajectory, it will have an absolutely insane impact on the world. And I personally believe that it's probably the most revolutionary idea that we've seen in our lifetime. But again, I'm not the right person to ask, because I'm very biased. It's in my financial interest to believe this. So I am biased, basically. Make sure that you take what I say with your sense of rationale, because I'm incentivized to believe that will be the outcome. It's just important to acknowledge that, because a lot of people say that, yeah, that's how it's going to work. No one knows. Great.
Do you think, since the narrative has been coming out saying that proof of work is not a viable option, do you think Ethereum will be moving on to proof of stake instead of proof of work? Do you think it is possible?
Ethereum is already moving to proof of stake. So now Ethereum is moving to something called Ethereum 2.0, where it will absolutely move to a proof of stake system. And actually, the Ethereum developer community has already implemented something where I believe every 100 blocks, there's one block that's mined via proof of stake, not with proof of work. So proof of work has had a very tremendous impact on the world of crypto. Crypto wouldn't have existed without proof of work, but there are challenges when it comes to the long-term incentives for proof of work miners. I don't want to make any type of prediction on this, because what I believe is crypto will become significantly bigger. Which one is the winning horse? I don't want to bet on that. Crypto is a $2 trillion industry. For crypto to reach 10 trillion, in my opinion, that's something that could very easily happen. But for me to pick which winner is very difficult. So why would I put myself through that process? I bet on the industry as a whole, which is why I'm a fan of diversified portfolios. Okay, there's the... Okay, very good question. There has been pushback by regulators. Chainalysis, which is one of the leading crypto AML tools, issued a report that says less than 1.5% of all crypto transactions are related to illicit activities. And we should also remember that when the internet first came out, some people were against the internet. They said, oh, this is being used for smuggling and drug trading and whatnot. You can't blame the medium or the technology. You have to blame the people. If I find $1 billion worth of drug money with Pablo Escobar, I don't blame the US dollar. I blame the drug cartels. So just like that, we should not blame Bitcoin for any type of money laundering activities. Humans will use technology for good and bad things. That is not reflective of the asset itself. But it's also important to remember that it's much easier to regulate something digital than it is to regulate something that's analog. If I give you suitcases of Pablo Escobar's cash and you take them and bounce, there's no digital trail of that. Whereas every Bitcoin transaction is immutably recorded on the blockchain. And I think it's a misconception that crypto is anonymous. In I think 6 months ago, there was something in the US where basically they tried to take Bitcoin from the US government as a form of there was a pipeline attack of some sort, and they asked for Bitcoin as payment. They paid them the Bitcoin and they tracked them. So Bitcoin isn't as anonymous as people think it is. And to your point on regulators cracking down, I do think that it is out of the bag that crypto is one of the most exciting industries in the world, which is why we're seeing governments and regulators around the world try to attract crypto startups and crypto entrepreneurs to come. So whenever a door closes, many other will open. Can you use the mic?
One person was in jail for paying off the debt, but then the government took the coins from him, and when the valuation went up, he was released and he was given that extra money.
Yeah, I mean, yeah. Again, when it comes to anti-money laundering related issues, it's very important to use a regulated exchange, because a regulated exchange in a jurisdiction that is legitimate will make sure that every deposit and every withdrawal and every interaction is compliant to basically all AML guidelines. Like if you sign up on CoinMENA today, we're going to ask you for your passport, your proof of address, your liveness check. And sometimes people think of it as a point of friction. Guess what? Not everything works for everyone. But at CoinMENA, we believe that crypto journey is a marathon and not a sprint. We're in it for the long term. And in order to be in it for the long term, you need to make sure that you comply with local regulations and anti-money laundering regulations, because honestly, they're very important, because they have a big impact on the world that we live in.
يعطيك العافية.
Thank you.
As you know, in our small company, we started paying people with Bitcoin and USDC, optional. So right now with CoinMENA, can we start a business account or a company account?
Yes, a corporate account is something that we're rolling out actually in the coming few weeks. We want to open up to, basically we're able to onboard GCC residents, Bahrain, Saudi, UAE, Kuwait, and Oman. And we've started off with individuals, but we're also onboarding corporations. So we'd love
small business.
Sorry?
Including small business.
Including small business. Okay, so the CoinMENA team are driven by specific motives, one of which is democratizing access to finance. And democratizing access to finance means you need to have a very low minimum, obviously one that allows us to commercially operate. But like I remember one of my friends wanted to open an account here in the UAE, and they basically didn't accept the account because his salary certificate wasn't high enough. Those are the types of things that as crypto companies we're working to solve. So even small businesses, obviously they have to go through the checks and balances of commercial registration, proof of address and whatnot, but that's something that any company that legitimately operates should readily have available. So yeah, excited to have you as a corporate customer as well.
Yes, thank you very much for giving such a wonderful presentation. So I'm a practicing lawyer here in UAE. So I'm also expert in ESG and sustainability matters. As we are all aware that the UN have 2030 UN sustainability goals. At the same time, United Nations Global Compact have given the 10 principles to follow for the corporations regarding environment, social, and like human rights and labor rights, including governance, anti-corruption, and anti-bribery. So these regulations are there, and the world is just following them. And there's a race regarding ESG, environment, social, and governance. So my quick question is that what do you understand? That how is the implication or application of ESG and sustainability measures on cryptocurrency and blockchain industry, if possible? Thank you.
Understood. So I think the biggest criticism for Bitcoin from an ESG perspective is the usage of energy, right? Bitcoin does use a lot of energy in order to verify transactions, but what's sometimes not accurately presented is that a lot of the crypto or a lot of the Bitcoin mining is actually happening from renewable sources. But to be completely honest, the ESG challenge or opportunity is something that and I think crypto will have a positive impact on, because even though it doesn't directly fit under ESG, but financial inclusion is something that will have a very big net positive on the world. Maybe on the S side of ESG, that's where crypto can come in, because just with your mobile phone, you can now access finance. That's not something that was previously there before. So if we look at ESG from an E perspective, from an environment perspective, crypto hasn't been a net positive so far, right? Bitcoin uses a lot of electricity, but similar to many things in life, you have advantages and disadvantages. So it's important to acknowledge what's not working right, and that's the Bitcoin consumption of electricity. And that's why Ethereum and other blockchains are coming up with other methods of verifying that aren't as energy intensive. On the S side, on the social side, I actually think crypto is an amazing net positive because it democratizes access to finance. And when it comes to governance, it's also very important because you can ensure that people's livelihoods and savings aren't diluted by the constant issuance of new paper money. Honestly, the intersection between ESG and crypto is one that only recently started to come out. There's states in the United States that give you tax breaks if you mine using green energy, like the state of Kentucky, for example. If you mine crypto using renewable energy, you will get a tax break. So I think we'll start seeing moves where governments try to incentivize people to look into the intersection of ESG and crypto. But if you're a lawyer and this is your area of expertise, putting in effort and research today will pay off massively or handsomely in the coming 10 years, inshallah. That's remains to be seen. Again, I told you I'm biased, but yeah, I mean, solar energy has its challenges from a storage perspective, but yeah, actually hydro renewable is the most popular when it comes to crypto mining.
Can I just contribute on that point?
Sorry?
I'd just like to contribute
Of course.
to the ESG point. So I think Michael Saylor's put together like a mining council where they're exploring like green solutions for mining. Another point I wanted to make is the current monetary system, like fiat cash, that's not very ESG friendly either. So, and then just one last thing I'd like to address. There was a gentleman asking about money laundering. There's a really good debate between Mike Green and Anthony Pomp. I just recommend it to everyone because they explore anti-money laundering and how Bitcoin is traceable and money laundering occurs just as much through fiat currency.
These are all very valid points, and the money laundering one specifically, I think, is one it's an easy way for people to say, you know what, it's happening through crypto. But the reality is, US dollars are the single biggest medium of money laundering, even if you take it as a percentage.
One final point, sorry. Regarding mining and ESG, with Ethereum as well, as you mentioned, Ethereum 2.0, because it's going to proof of stake, it should be a lot more environmentally friendly as well, because you won't have miners.
Great. Any other questions? Going once? All right, cool. Going twice? لا يلا. Okay.
Is XRP a security?
I am not a lawyer, and my compliance officer would shoot me if I answer this question. I don't know, man. I honestly don't know, and even if I knew, I wouldn't want to answer this question. Sold. Thank you.